This is level 3 of the CFA program, the topic on derivatives and currency management, and the learning module on options strategies. Those of you who looked at this learning module might think that the reading is about 1,000 pages long, but it's really only about 70. But there are lots of LOSs and lots of topics and lots of great potential exam questions. So what we've done to try to make it more palatable for you candidates is that we've divided this into 3 parts. So this is going to be part 1. And the good news for you during this relatively brief recording is that we're only going to do that first LOS. The other piece of good news is that you'll notice that typically somewhere in the beginning, but most likely in the end of the recordings, I send you to the end of the learning module to take a look at the end of reading problems. As I skimmed through, there are 23 or 24 of them, three vignettes. I don't think there's really any that address this particular LOS. But the important part of this slide deck and the first handful of pages inside of this learning module is that it lays the foundation. So we're going to demonstrate how an asset's returns may be replicated by using options. And I'll just skim down here. That replication is going to help us understand the covered call, the protective put, the spreads there at the bottom, and then we'll go ahead and move on to some volatility things. But remember what we learned back in level 1. We learned pretty much that there are derivative securities out there. We defined as some security whose value is derived from the value of some other asset. So there's a good pie chart with all of the different types of underlying assets. It seems to me that the Institute is very interested in stock options. And so that's pretty much the focus of our slide deck here, and probably going through the rest of kinds of derivatives. But remember that you could be faced with almost any kind of an option contract on any of these underlying securities. So here's a really good review slide of terminology. I'm clearly not going to go through all this stuff with you because, boy, I say this to my students all the time and they resent me. They give me the little beady eyes. I say things like, you should know this from a previous class, or you should know this from what I taught you a month ago, or you should just know this in general. So there's the option terminology, right? A call and a put, European and American, intrinsic value, time value, those things are all super definitions that I'm guessing that you recall from level 1 and level 2. Here's my advice, that when you take a look at the vignette, make sure that you pay close attention to all of this terminology, because the Institute and any good question writer will just throw all this stuff at you, like in the first paragraph or maybe a table. And so it's probably important. Of course, you have to know the difference between calls and puts, but it's probably important to know the difference between American and European style. And then I always ask this question on my exams. I'll give the students, I'll give them a call price, and I'll give them an exercise price. I'll give them a stock price, and I'll ask them for intrinsic values and time values and call premiums and all those kinds of things. So those are simple mathematical problems. I mean, in fact, they're so simple. I mean, really, you're just adding or subtracting. You learned that back in kindergarten, but you need to know those definitions to be able to do that. One final quick slide here. In and out of the money. Remember the difference between the call options in the money, and then you just turn it upside down. That's why we have the arrow going up and the arrow going down, is just the opposite for the moneyness of a put option. And once again, I'm just guessing that you recall all this pretty accurately. If you don't, then take a look at it right there, and I'm guessing you're saying, hey, you know what, Jim, I do remember that. Now here are the pictures. So there's a call option on the far right upper, and there is a put option on the far right lower. Make sure that you understand the difference, especially in the essays when you're answering these questions. Make sure you pay close attention to the question, right? If the question says, what is the profit at a particular stock price? That's different from what is the payoff from a particular stock price. So make sure that you are answering the question that is being asked. My students, they love answering questions that they would like me to ask on the exam, but which I didn't. So blue lines and dotted lines, and these are super easy to remember. Of course, if you have the call option, what happens? You win when the price goes up. When you have a put option, you win when the price goes down. All right, how about that LOS here? Demonstrate how an asset's returns may be replicated. And so essentially, what we're doing is we're relying on the integration of capital markets. I mean, we can go to the New York Stock Exchange and we can buy or sell a share of stock like John Deere, and we can go to the bond market and we can buy or sell a particular fixed income security like a treasury bond or maybe a bond issued by John Deere. And then we can go to the derivative markets and we can buy a forward contract on John Deere stock. We can buy an option contract, whether it's a call or a put. So you have these three markets that are working, and you might be tempted to think, oh, that stuff goes on over there, that stuff goes on over there, that stuff goes on down here, and they may or not be linked, but that's not true. They are super linked. These markets have to be integrated so that if there's a mispricing, then these arbitrage individuals can just jump in and return those prices in each of those three markets, right? The stock market, the credit market, and the options market. And so if that's true, what I just said, and of course you should recall that from level 1 and lots of level 2 stuff, that if we don't have arbitrage conditions, then what happens here, let's say on the floor of the New York Stock Exchange, you can replicate that with stuff that goes on, with buying or selling that goes on in those other markets. And so that's all this means, replication. We're going to use an option, and we're going to take this option and we're going to hold on to it, and it's exactly like holding on to a share of stock. Now we have to do some things, some specific things over in the options market. So this is the way the learning module proceeds. So we're going to replicate asset returns using options, right? So let's take a look at a stock / or a forward contract, the long position in a forward contract, how these returns can be replicated using options. So look what we've done in the red there. Let me just give you a super simple example. You'll get this even if you haven't paid any attention to anything we did in level 1 or level 2. If you buy a stock today for $10, price tomorrow is $11, you have an unrealized gain of $1. Of course, you could sell it and have a realized gain, but that's not too important, right? Or we could enter a forward contract today. There's the long forward at a price of $10. And if that price tomorrow is $11, then that mark to market, and this could be a forward or a futures contract, right? That mark to market gain is going to be $1. All right. So buying the stock and having the long position in the forward contract, they both have that gain of $1. Forget about the realized or unrealized portion of it. So now we have to ask ourselves the question, can we replicate that $1 with an option? And the answer is of course. So look down below. We're going to have a long call. So we're going to buy a call and then we're going to sell a put. Long in the call, selling the put option. Now, this is super important. The two options, they have to have the same exercise price and the same expiration date. And of course, they have to be written on that same underlying asset. Now, what the learning module does, it goes through, not too detailed, but detailed enough. And it comes up with the two bolded equations that we have there in the bottom right. S sub t, which is the stock price at some period in the future, right? An uppercase T. So maybe that's the expiration date of the option, minus K, which is the exercise price. And so you can go through the learning module and you can kind of make sense of that. But this is why we put this down on the bottom. So let's go ahead and look exactly at how this replication works. We're going to buy a call and sell a put at an exercise price of $10. All right, so notice that the exercise price here, that's the same as the forward price above, and it's the same as the stock price today. So that's probably relatively important. But if the price tomorrow is $11, the value of the call is 1. I'm just assuming that it's a one-day option. So forget about present values and Black-Scholes-Merton and the binomial model, any of those kinds of models. The value of that call is $1. The value of the put is 0. So there's your $1 if the price goes up to 11. So you might be asking the question, well, what if the price goes down? Now, we didn't put that in red up at the top because it's just so obvious that if the price falls to 9, then the stock ownership has a $1 loss and the mark-to-market is a $1 loss as well. But look at how it works with this combination of the long call and the written put. If the price tomorrow is $9, the value of the call is 0 and the value of the put is 1. So 0 plus 1 is 1, 1 plus 0 is 1. So you're replicating with two options what goes on in those other markets. So what did I say? Here's the stock market, here's credit market, and here's the option market. So we're assuming that there's no arbitrage conditions based on all of those topics that we were taught by Harry Markowitz and Modigliani and Miller and William Sharp, Black-Scholes-Merton, all those really, really smart men. And there are tons and tons of smart women out there as well that have taught us all about no arbitrage conditions. Now, when I was looking at the end of the learning module problems, I was just thinking that the Institute was going to go ahead and ask you something like this, but they really don't. And so I was thinking, boy, this really is setting the foundation, right? We're building the foundation so that we can answer the rest of those LOSs. But what becomes really interesting is this next step. And this is really important here. Because this stuff right here, although that is not exactly asked on those 23 or 24 questions at the end of the learning module, they provide us with a great opportunity to answer those. All right, so remember that previous slide where we had the 10 and the 11 and the $9. So let's go ahead and see if we can do this some other way. Well, yeah, we can do it some other way. How about if we borrow the present value of the exercise price, and then we immediately buy the underlying stock and hold that stock until the exercise date of the option. At maturity, the net value of that position is going to be the same. Well, let me go back here. It's going to be the same ST minus K. All right, so what did we do here? Now we linked the credit markets, right? We're borrowing at the present value of the strike price. And remember that there is a variety of reasons why we use that risk-free rate of interest to value options. We'll talk about that in another recording. But we're going to be able to borrow at that risk-free rate of interest, and then we're going to do all this, and then we have ST minus K, that same, well, what was it in the previous slide? 11 minus 10. Look down under the notes there. Yep. According to the law of one price and all those no arbitrage conditions, it must have identical costs. So this is where we get to put call parity. We're linking stock markets, credit markets, and option markets. So what we're saying is that the call premium minus the put premium has to be equal to the beginning stock price minus the present value of the strike price because of the mathematics that we did, kind of briefly at the top of this slide, but it's still the mathematics that we did back here, even though this was a super simple example. Now let's take that relationship and let's rearrange, and notice that gives us what we learned back in level 2, and we called that put call parity. And I'm going to give you a way to memorize put call parity, and you'll never ever get this wrong. So on the left hand side, what are you doing? You're buying the stock and you're buying a put option. So S plus P, S&P 500. So remember, on the left hand side of the equal sign, that you're going to do S plus P. And on the right-hand side of the equal sign, you're going to replicate the payoffs of the stock and the put with a call and the present value of the exercise price. Now, what we're doing is we're going to call this, at least I'm going to call this, I've never seen this anywhere. So this is Jim's terminology. So on the left-hand side, what do we have? We have S&P, and on the right-hand side, we have a bonded call. Now, it's my term because what we're going to do is we're going to take the present value. What does that say at the very top? Borrow the present value of the strike price. So what we're going to do is essentially buy a bond today that matures, that has a maturity value equal to the exercise or the strike price of the option. So call plus the present value of K, you're doing plus the present value of K, you're doing all that in the credit markets. So think S&P on the left-hand side, bonded call on the right-hand side, and you will never, ever get a put-call parity question incorrect. Now, we'll talk at length in the part 2 and maybe even part 3 of this recording about what is that left-hand side. That's known as a protective put or portfolio insurance. And I'm going to continue to call that on the right-hand side the bonded call. But what you can do is you can rearrange those to synthetically replicate. So for example, and we're going to do this in the next couple slides, but let's look at that bottom equation. If I subtract the price of the put option from both sides, what do I get? I have the stock price on the left-hand side, and then over on the right-hand side, I have the bonded call. And now remember, that's a minus P, so writing the put. So if I don't like the price on the floor of the New York Stock Exchange, that's the stock price 0. If I don't like that price, and I only plan on holding that stock for, let's say, 6 months, well, then what can I do? I can go to the credit markets and I can borrow the present value of that exercise price, and I can go to the option markets and I can buy the call and I can write the put. That's this idea of replication. Now, here's a graph that the Institute puts up because they're interested in making certain that you can go from put call parity, which we did just on the last slide, to put call forward parity. And so all we're doing is replacing the stock price with the present value of the forward price. And so you can imagine what did we do earlier? We had the stock price, right, from 10 to 11, and then we had the forward contract from 10 to 11. And so all we're doing is substituting that present value in there. And so all that stuff holds true. And notice that that red line, of course, that red line has to be the relationship between stock price and payoff for the stock and for the forward. But also notice what we've done here. We put long call in the money, short put in the money. And so look at that second teardrop point over on the right. A synthetic short forward position is composed of a long put and a short call. So options positions can be replicated using all sorts of stuff. And notice there's the arrow, the light bulb over there. Rearrange put call parity algebraically. And that's what we've done here for you on this slide. And so I think this is one of those slides where I think you ought to get your phone out, take a picture of this, put this in your folder for level 3, and call them, what did I tell you to call them earlier? Jim's file for important stuff to memorize. And so clearly we're just rearranging, just like I said just a few moments ago, synthetic call and synthetic put, and you can look at all of the synthetic combinations, and clearly all we're doing is rearranging the put call parity formula. So let's do just a super quick example here. 6-month contract, 5,000 shares, $3.39 at maturity. Current price is $3. Notice that we tell you that pays a dividend after the contract expiration, so you don't have to worry about that dividend. Interest rate 1.5%, and both the $3.39 calls and puts are currently trading at 31 cents per share. Don't really worry about the fact that they're trading at the same price. That's just for simplicity here. So let's go ahead and answer 2 quick questions. How can we hedge short position using a synthetic long forward? Well, there's the answer at the bottom. So we're going to have that synthetic long forward. We're going to buy a call and sell a put. And here's the key. They have to have an exercise price equal to that $3.39, which is the same as the price of the forward contract. Then part B, what happens if the share price is up or below $3.39? I do this in my classes all the time. In fact, I just gave a final exam in my investments class where the students had to tell me what happens if the price goes up, what happens if the price goes down. These are really, really great questions. So, I'm not the only one that does this. The Institute does this as well. And boy, if you take the FRM exam during the course of your lifetime, you'll have to do the same kind of thing. So let's work through the math just quickly here. So if the stock price at expiration is greater than 339, we're going to exercise that call option. We're going to receive 5,000 of those ABC shares, and then we'll deliver those shares. We'll receive the 16,950. If the stock price is less than 339, the put option will be exercised, so we'll receive those 5,000 shares for the 16,950, and then we'll deliver those shares and get the 16,950. And that takes us through this first LOS. Let me just remind you that this is providing us with a great foundation to be able to understand covered calls, protective puts. Boy, I just mentioned protective puts, bull spreads. We'll do all sorts of spreads. And then when we get to the third part, then we'll go ahead and talk about those option strategies. And I like this last one here, a targeted equity risk exposure. And so you notice how the Institute is really, really interested in you knowing basic stuff, but then they really want you to, it's not linear. It's linear. So it's exponential, and they want you to be able to answer some pretty high level questions. So, hey, thanks for watching, and I will see you soon in part 2. Have a great day.